Yeah, don't let out our secret. But if you do a good job for the client, you're going to sell a boatload more policies.
Well, no,
you're going to win. But point is, the average guy sells 2 of these a year, and he's looking at how do I maximize my comp versus this is all we do. This is all we do. We maximize the client's cash value, minimizes our comp, works out for us in the long run.
At MBA Chartered Professional Accountants, we have 3 core beliefs. 1, we believe that business owners are the most important people on the planet. 2, we believe that the traditional accounting firm business model is flawed and fails to serve you. And 3, we believe the MBA way gives you what you truly want and deserve, resources and advice that helps you grow your business and your life. This is the MBA Way podcast. Hi, everyone. It's Eric, and welcome back to the MBA Way podcast. Today, we have my good friend, Darren Mitchell. Darren is the creator, the CEO, and the creator of Control and Compound Financial. Now, what we're going to get into today is something that a lot of people don't like talking about, but is so critically important if you own and run a business. We're going to start talking about infinite banking. We're going to talk about insurance. We're going to talk about how cool Darren is and how much we love being in the same social circles and in the, well, I shouldn't say social circles. You live on the other side of the bloody country. What the hell am I talking about?
Small world.
So small world, but we are in the same coaching program. We're going to get into all things insurance related, and you're going to find out some incredibly interesting facts that you can use in your business that you never realized was available, because Darren is a wealth of information and knowledge. Now, with all that pumping up of the tires, brother, welcome to the podcast.
Thanks, Eric. Happy to be here.
So tell me this. Let's dive right into this. I hear this. I kind of seeded this. I said, infinite banking. What the fuck is into infinite banking?
Yeah, okay, we can dig into that. Then I want to back up. So infinite banking in itself, it's a concept. It's called the infinite banking concept. And there's a lot of people out there that bastardize it. They do stuff they shouldn't be doing. If you can fog a mirror, you shouldn't do it. I focus on business owners and real estate investors because I think those people, and wealthy individuals, but business owners and real estate people, I think, are the best situated for infinite banking. But in a nutshell, you're saving your money. You have to save your money someplace. We think the best place to save at least a portion of it is in this high cash value life insurance policy. So that the product we use is this high cash value insurance where we're driving the death benefit down, we're driving the cash value up, we're compounding for the rest of your life tax-free. But from a business owner perspective, it's the ultimate place to save money, to leverage money, to retire tax-free, to take care of all those tax bills down the road, to provide a legacy, protect your family, and allow you to have a much higher income in retirement. So that's kind of the concept, and we can dig into the details. But for me, it's, as a business owner myself, it was like I used to do one of 2 things. I'd save in the short term, put money in cash, and then I'd put money in RRSPs, same thing. I put money in RRSPs, and then that was it, right? That money. So when an opportunity came along, I didn't have money. So I'm a big believer, and I talk about this in the book. If you want to be rich, you want to be wealthy, there's only 3 places you should invest your money, and any financial advisor that tells you any different, I think, is wrong. The 3 places to invest your money, you should be investing in yourself. You're the greatest asset you're ever gonna make. So us joining coaching classes, making yourself better, taking accounting courses. I know you don't like that word. I don't either, but I've taken accounting courses for small business owners. Anything you can do to I took my son to see Tony Robbins in grade 12, to pump him up. Like anything you can do to make yourself better, get a coach, join a group, make yourself better. That's the greatest investment you're ever going to make. I don't care anything. Second thing is you invest in a business or you start a business. And the third thing is real estate or some other fixed asset. So I think that is where people should be investing their money. I direct them to say, this is what you should be doing. But step 1 before you invest is, where do you save it? And I think the most efficient place to save it is in this cash value life insurance, especially for a business owner, because of the corporate tax stuff we can talk about. But you save your money, it's guaranteed to go down, it's bulletproof. So when that opportunity comes along to say, hey, I can buy this piece of land, this building, this competitor, grow my business, finance this piece of equipment myself, survive this downturn, you are 100% in control of your money. If you've got 300 grand in a cash value life insurance business and real estate drops 30% and the stock market drops 50%, your cash value life insurance is worth 300,000 plus roughly a 5% growth rate a year, tax free. So you're guaranteed always to be in control of your money. And I think that word control is the most important word in English language with respect to money. Business owners take enough risk in their life. I think the foundation of your financial plan is going to be rock solid and bulletproof to say, listen, I want to take risk in my business. I want to take risk maybe in some real estate, maybe it's a Bitcoin, whatever you do. But for this foundation of my financial plan, it's going to be rock solid and bulletproof, because typically when the opportunity comes along for us business owners, it's when everything else is collapsing. So I want to encourage business owners, take control of your finances. Don't give it up. Don't give your control to a financial advisor, a mutual fund, a bank, or whatever. Keep control of your money.
So there's a lot to unpack there, dude. And I like how you put in the word control, because that's your business, is control and compound. I love that.
Yeah.
So and my apologies for kind of jumping right in the deep end of the.
Yeah, no.
What is this? What is this? Infinite banking. Everybody talks about that, but I think I probably touched on a bit of a nerve there, and something that I'd like to investigate a little bit, which is with life insurance, it has a stigma around it, right? It has a negative connotation. Obviously, part of it is because we're talking about having insurance for when you die, which people don't want to even talk about or think about. So that has this kind of natural negative connotation. But the other side of it is the snake oil salesman trying to, selling you something you don't really need. And the one thing I've really learned about you when we met and we started talking about it is you're actively educating the public. You've got a podcast. You've got a book called Be the Bank. You're actively educating people on what's good, how insurance can work well for them, and to getting away from the, shall we call it, infinite banking. Almost sounds like another one of those little catchphrases that is trying to capture people's attention and kind of shock marketing type thing. But you, as soon as I said that, you kind of went, oh, okay, well, yeah, but let's talk about something else, Eric. I want to just highlight the fact that you're changing, I believe, the stigma around the whole profession, and you bring an educational piece and a personal, what's the word I'm looking for? Some common sense. Like what you just shared with us there and all our listeners. I mean, that's valuable right there. 3 places you should invest in yourself: invest in yourself, invest in your business, invest in real assets, like real estate. Not very many financial advisors would ever say that, because I didn't hear you should be investing in stocks and bonds and diversified portfolio. Like, you actually bring a common sense approach to it. So I'd like to kind of go back to allowing you to kind of set the stage and do the education piece that you do on your podcast and when you're talking to people, so that everyone can understand where we're coming from. So if we could do that, would be great.
Sure. So where do you want to start? I
kind of jumped in the deep end. Hey, what's infinite banking? You were like, oh crap, Eric, you're like sprinting around you're sprinting around the goalpost here, like, quickly before we're even talking about the rules of the game. Like, let's get some terra firma to understand just the basics of what it is that we're talking about here before we go into the super high level details.
Sure. So if you accept my first premise that if you want to be wealthy, you should be investing in yourself, your business, and your real estate. Well, you're not investing every single day. Every dollar that comes into your business or into your personal account, you're not instantly putting that. So what do people typically do? They give up control of that money. Okay, so they give up control of that money. So who wants control of your money? The banks. How do they get control of your money? Systematically take it every 2 weeks if you get a paycheck. Take your business deposits the second it goes in, it's in the bank, and the bank takes that. What does the bank do with it? The bank leverages that, loans it out to multiple people. They're in control of your money. So first step is, I want to say, okay, if you're going to invest in yourself, business, and real estate, you've got to take control of your money. So when that opportunity comes along, you can take advantage of it. So I'll give you an example. So let's say you have $500,000 in cash value. We can get into let's start there. There's 2 components of an insurance contract. There's a cash value and a death benefit, right? 99% of people are buying insurance for death benefit. They come in and go, hey, I want $1 million, $2 million in case I die, spouse and kids will be fine. That's not what we're talking about here. What we're talking about is the other component of life insurance, which is cash value, which most plans don't have. So what we're saying is, let's drive that death benefit down as small as we're allowed to legally to drive the cash value up as high as we can. And that's what we kind of consider your bank, right? So let's say I have $500,000 in cash value in my insurance policy or policies. And now their amazing opportunity comes along. Let's say I can just buy the building I rent now, and I need to come up with a couple $100,000. Well, as a business owner, typically those deal of a lifetimes happen because somebody needs money and somebody has access to money. I want to be the guy that has access to money. So if you were to say, I need $300,000-$400,000 in that case, up to 90% of your cash value, you can get from the insurance company, no questions asked. So if I have $500,000, I could call the insurance company today and say, I'd like 90% of that, or $450,000. And the insurance company would ask me two questions. They would say, do you want a check or do you want to deposit in your bank account? They wouldn't ask me what I was using it for. They wouldn't ask me for financials. They wouldn't say, oh, I see your business is a little slow this year. They wouldn't ask me any other questions other than where do you want the money deposited? So for me, that control even outweighs the compounding, and we can get into the compounding. So you want to be in control of your money. So in order to be in control of your money, you need to store it someplace that you're in control. And to me, that's only cash or cash value. So if we were to look at sort of a hierarchy of wealth, and the bottom of that pyramid, I think, has to be a position of control, and that's cash or cash value. And I can tell you why cash value is a million times better than just cash. But once we establish that cash value, we're going to say, okay, that's going to compound forever. Okay, it's going to grow roughly at 5%, plus your death benefit's going to go up. But now I'm going to act like a bank. And what do I mean by that? In my example there, I need $450,000 to buy a business, grow a business, do whatever. I'm going to borrow $450,000 from the insurance company. They're going to say yes because it's contractual. They loan you 90%. But I still have $500,000 in my policy. So now my money is in the policy, compounding tax-free, that I can use for a tax-free retirement, and it's still providing a death benefit, and I'm able to do this other investment. So I've multiplied money like a bank. Instead of the bank multiplying money, I'm multiplying money. But that position of control is huge for me. I don't need to ask the bank. And then even if I do borrow it and I still need to go to the bank, that loan, they don't treat as a loan for borrowing capacity. So they're not going to consider that a loan. It's not going to show up in a credit report. I can borrow for a down payment if I want to buy a building that I'm currently renting. So that control is huge. So that's kind of step one, is if you want to be wealthy, and this is what wealthy people do, invest in themselves, business, and real estate, you've got to be in control to take advantage of opportunities, but also deal with emergencies. Because guess when the bank doesn't want to give you the money? And I had a lot of clients during COVID that the bank didn't want to give them money, but the insurance company contractually would give them up to 90% of their cash value, no questions asked. And that loan that you get, you can pay that back when you want, how you want, and if you want. It is the holy grail of loans.
Okay, so again, I think we went kind of deep in.
I get excited, Eric. Sorry, I get all excited.
We went deep into the pool. Deep into the pool here. Let's just to simplify this down, because I understand the insurance to a certain degree, enough to be dangerous. Let's say I understand it enough to be dangerous. I kind of break it off into two types of insurance, right? You have term insurance, and then you have like a whole life, where you can actually. So term insurance is what you're talking about, this death benefit. I just go and buy $1 million of term insurance, so I pay premiums on that to get paid out $1 million if and when I die. When I die, if the plan is still in place and I'm paying premiums, that money gets paid out and it can be used for my beneficiaries.
Yeah, let's stay on term though. So term insurance is going to be pure death benefit, zero cash.
Yeah.
Nothing wrong with term insurance.
Yeah.
It's great for a 10 or 20 year period. Then it blows up. Then eventually it gets to a price you don't keep it, and eventually it expires. About 1% of term insurance policies pay out in Canada. But if you want to...
Sorry, say that again. Say that one more time.
1% of term insurance policies pay out in Canada.
Okay, I need everybody to just hit the pause button right there for a second. 1% of term insurance gets paid out. That means that 99% of us are paying money into an insurance policy that will never pay itself out. That is staggering. That is a pyramid scheme if I've ever heard of one. That means, like, do you follow me where I'm going here? Like 99% of the people pay for the 1% that get the payout.
My house has never burned down either, but I'm pretty happy I have fire insurance.
But I know that, but what I'm just saying is that for the term insurance, what I'm trying to set the stage for here, Darren, is like going, if there was a way for you to pay for insurance to have that coverage and start building up wealth and then being able to expand on that and go into these levels of borrowing and leveraging and all the rest that you're talking about, then we don't look at term insurance. We look at a whole life or a universal life where there's two components to the insurance, right? So where there's a death benefit and then there's a cash surrender value. So when I'm paying a premium, I'm just going to take a silly number. Let's say I'm paying $100 a premium. Half of the premium goes to the cash surrender value. Half goes, say, to the insurance piece, the death benefit piece. You said something at the beginning of this podcast that you said you work on reducing the amount of the death benefit and maximizing the cash surrender value part. I'm very curious on the reasons for that. Why is that?
So there's term insurance, there's permanent insurance, there's UL and whole life. For today,
sorry, that's I should have called it permanent. That I was missing that terminology.
For permanent
versus permanent. Yeah.
I'm just going to sum it up really simple. UL bad, whole life good for this exercise. Okay. So for what we do. So if you have a whole life plan, again, 99% of policies are sold for the advisor's benefit, which means we sell as much death benefit as we can. Okay. And when you talk whole life, you're not going to get a lot of death benefit compared to the term. Now, the reason for that is the whole life death benefit, if you keep it for life, will pay out 100% of the time instead of 1% of the time. So the cost is more. But the second component of that, in every whole life plan, there's what we call a minimum premium and a maximum premium. 99% only sell the minimum premium. And that's basically what the insurance company to say, all right, Eric, a 40-year-old guy like you or whatever you are, we're gonna say for $100,000 of death benefit, this is the minimum premium we need. But the maximum premium, so let's say that's $100 a month. But the maximum premium is the amount that CRA allows someone your age at that death benefit to contribute to. So that extra deposit or additional deposit option, it's called, that is the secret sauce for growing your cash value. So that extra money is going to go in your balance sheet, where now I have a cash surrender value. And if you have a cash surrender value of $100, you could cancel the policy tomorrow and take $100. So it is no longer an expense like term insurance, an expense like my car insurance. This is a savings or asset that I'm putting money into here. So when we design the plan, we go, well, how do we maximize the good stuff? In this case, the cash, because the people we're talking to are business owners going, yeah, I need some death benefit maybe, but I'm interested in where do I save cash and get all these other benefits. So what we do is we say, if you want to, instead of starting with a death benefit like, hey, I want $1 million of death benefit, we say, how much do you want to save, or how much do you want to store? How much wealth do you want to store in here? And let's say you say 25 grand a year. I'm going to say, great. We will design a policy that the maximum premium is 25,000. And that means the death benefit is the smallest number we can. And it might come out to something like $311,123 a death benefit, right? Like a funny number like that. But that's how we design it to maximize the cash value. The benefit of the cash value is now you have an asset that you can use for a future tax-free retirement. You have an asset that you can leverage for opportunities in emergencies. You have an asset that will grow tax-free for the rest of your life. You have an asset when we get into the business stuff, how it eliminates 5 levels of taxation. So now we're saving into this savings vehicle, this asset, where our asset is compounding just like a bank account is. This is like a bank account on steroids. Your money's going to be compounding forever and ever and ever. But if you need the money in the short term, you can leverage it without affecting the growth. If you don't, if you, like I probably borrowed on some of my policies 10 times. my cash value is exactly the same today as if I never borrowed on it, because the loans don't affect my growth because I'm never actually cashing it out. So I've used that policy to do 10 opportunities along the way to invest in my business. And at some point, I'm going to have a boatload of cash value in there, and that's going to provide my retirement. So short-term and long-term.
You just said something there. The three places do you invest in that do you believe we should invest in is ourselves, our business, and real estate.
Yeah.
What you just explained there about this cash surrender value in a life insurance policy, when you're putting the money in, you told me that you've borrowed against that 10 times. The value of it has never gone down. It actually continues to grow. That cash surrender value is exactly like real estate. That's how real estate gets treated, because I have like a home equity line of credit. So I have a house that's going up in value every year. The value of the house doesn't change, but what I can do is I can borrow against it. So I go and borrow against the real estate with a home equity line of credit, take that money, borrow it, use it, do something with it, and pay the money back. It doesn't affect the value of the real estate, the house. That's exactly the same way the cash surrender value is. It's the same idea.
Same idea, but a couple questions. Is your house guaranteed to go up every year?
Well, and if I live in Victoria, apparently it does, because, dude, the prices in Victoria have gone up and up and up and up and up. But yes, I hear what you're saying.
It's not guaranteed.
You can have a crash.
Required to pay the interest, typically on a line of credit. You're not you can capitalize the interest on this. It is callable if your financial situation changes. Banks call lines of credit all the time, but very similar. Yes, you're borrowing against an asset, and it doesn't come with a death benefit. But yeah, other than that, it's very similar.
So let's just highlight some of the benefits here, because you said the other thing is that if I go to say I need to borrow some money today, and so, for example, my wife and I, Aaron, we bought a new house in Victoria, and we bought into some more real estate, and we bought some assets, and so we've kind of maximized our borrowing capacity, so to speak, right? So if I was to go to the bank today and say, hey, I want to buy this, I want to jump on this opportunity to buy this other real estate, they would go, sorry, you've overextended. And because just recently, the government also changed the amount of money you can borrow on real estate. They've dropped it down, right? I used to be able to have a HELOC up to 80%. Now they've dropped it down. So my borrowing capacity keeps getting lower and lower. The government has made it so that I can borrow less and less. But you said something about the cash surrender value. When you go to borrow that doesn't affect your credit score, does it? It doesn't affect your borrowing capacity. So you can borrow against it without having to go to the bank. And that's hence why the book is called Be the Bank. You're your own banker. And hence where the term infinite bank, I guess infinite banking is a different phrase. It's probably got a bunch of other things baked into it. But it's the idea of not having to go to the bank and beg for money. I hate begging for money. I hate going to the bank and asking them for money.
Right. So I hate going to the bank too. Sometimes I like the bank. So for your real estate example, great. I'll go to the bank and borrow the 20 or 30% for the down payment, and then I'll go to the bank and get the mortgage. Right. So you can do it now if it's, for an investment, where I invested in a real estate LPGP deal the other day, couple $100,000. Great. There's no bank involved. I use the insurance company's money, use my cash value as collateral. I put the money in. 2 years later, they're going to give me the money back. I'm still going to have the equity. That was just what we call an and asset. My money's in the policy, and it's providing a death benefit, and I took advantage of another opportunity. My money was in three places at the same time, effectively.
So we've talked about a whole bunch of stuff here. And for the listeners there, I apologize if we've gone down the deep end of the pool here. Darren and I get fired up and all over the place. For the person who doesn't really understand real estate at all, and where to get started and when it's useful, I found that to actually apply it simply and use a common sense approach. And since I've met you and we've talked, you're very commonsensical about how to do things. And that's why I'm kind of highlighted that I believe that you're changing the stigma around this profession, around this era, to try and give people understanding of what life insurance is. Different life insurances have different applications to different phases and different points in your life. You know what I mean? So, for example, I'm a young father, I got a young family and all the rest of that. I'm healthy and all the rest of that. I don't have a lot of excess cash. Maybe some term is good for the moment, right? Just to protect the family in case I get hit by the bus, right? Until I have that extra cash flow. When, especially for our listeners here, when should they be thinking about investigating permanent insurance? Like, where's the threshold on that? Because I've talked to a lot of business owners. They're like, "Oh man, I can't afford the premiums in an insurance policy. Like a permanent insurance is way too high." But you said something else in the podcast that kind of made me think a little differently. Is that you said you reverse engineer the policy the other way around. See, anytime I've talked to insurance people and I said, well, I currently have $1 million over here, and they're like, oh, well, $1 million of permanent insurance is this, and the premiums go through the bloody roof and my eyeballs pop out of my head. I'm like, holy crap. How am I supposed to come up with that premium? If I'm hearing you correctly, you'd be like, no, Eric, okay, you have $1 million of policy over here, but let's reverse engineer what you actually really need and how much you'll build up over time. Maybe you don't need the pure insurance part of $1 million. Let's drop it down as low as possible and increase the cash surrender value to fit it into your budget, and then see it. Does that accomplish what we're trying to accomplish here?
Yeah. So I'll answer your question directly, and then we'll back up. So my belief is, unless you're able to save at least $10,000 a year on an ongoing basis, you're not ready to talk about this. Okay. So if like people call our office all the time and say, hey, can I put $200 a month in this? And we say, listen, this isn't the best spot for you right now. You should work on improving yourself, your business, your real estate, improving your income, lowering your expenses, whatever you got to do to save money. So for that person that you said doesn't have a lot of money and has a young family, I think term insurance is great for them. And to your snake oil salesman comment about my industry earlier, I think that's where the real frustration for me is you will have an insurance advisor go into that person that has a few $100s a month, and they will put them in a whole life plan that is going to pay the advisor well, because they're not going to put in the extra cash value. Okay, the death benefit's what pays the advisor the best. And that person might be 30 years old coming out with a death benefit of $300,000 with a tiny little bit of cash value. And I think that is a horrendous idea. That person should have had the $1 million or $2 million of term insurance for $50 or $100 a month, because if he or she dies, that family is screwed, and $300,000 is not going to cover it. So we tell people no all the time. So we call ourselves financial educators. You have to sit through 2 education sessions, read the book, listen to a couple podcasts before we'll do business with you, because we don't want to be in a situation where someone is doing this and is strapped for money and doesn't have enough money to put the second deposit or third deposit in, because that can hurt you, right? That in the insurance world, you've got to pay a couple of years before it's got to be stable enough. So until you're saving $10,000 or more, it doesn't make sense in my view. All kinds of people out there will differ, but that's what we do in our shop.
Again, this is why I love the fact that you're in the business of educating people around insurance and insurance products, and when it's the right fit for them. You know, you got your podcast, fantastic, Control and Compound, by the way. I'm going to just make the plug for it right now. Everybody got to go listen, look at this, Control and Compound. And we'll talk about the different areas they can get some more resources from you at near the end of the podcast. I want to do that, but I just want to, again, I want to give you a big high five on this, man. Like you're doing something outside of the realm of the profession. And I love that. You know, with me, the accountant success formula is about breaking the mold and breaking the model outside the accounting profession. I really see you doing the same thing here with the life insurance, the permanent insurance space, is giving people education and understanding so that, and fitting it to the right person, the right product to the right person at the right time. Now, I want the listeners, if you didn't catch this, I'm going to highlight this. Darren said something here that I want you to really soak up. He said that at Control and Compound, they try and maximize the cash surrender value and minimize the death benefit because it works better for you in the long run. Being able to leverage the cash surrender value, having the freedom to control your money, and to have it always grow and compound exponentially without tax inside the policy. He then said that the death benefit, the higher the death benefit, the greater the payment to the advisor. So he just said, and correct me if I'm wrong here, D, you said that you're actually working to get paid less on these policies than other advisors, because if you're trying to reduce the death benefit, you have a premium getting paid out to you.
Instead of putting that extra premium in the additional deposit option that gives the client way more cash value, I sold all death benefit. On that portion of the premium, I make 10 times more money.
You make 10 times more money on the death benefit.
And I'm not rounding up. It's 10 times more money.
10 times more. So this is, again, why I want to highlight this for the listener. You're actually advocating for your clients to have you get paid less because it's better for them.
Yeah. Now again, don't let out our secret. But if you do a good job for the client, you're going to sell a boatload more policies.
Oh no,
and you're going to win. But point is, the average guy sells 2 of these a year, and he's looking at how do I maximize my comp versus this is all we do. This is all we do. We maximize the client's cash value, minimizes our comp, works out for us in the long run.
Well, you see, this is what drives me crazy about the whole thing, and this is why I tongue in cheek was talking about it being a pyramid scheme. If 99% of term policies never pay out, that means there's a lot of profit on the table. There's a lot of premiums getting paid in and not a lot getting paid out. That's what I love what you're doing here. And I had no idea about this part, by the way. Like, this is something I learned new. And this is why I love doing these podcasts, because I learned something new from every single one of my guests. And you just showed me that about the death benefit, is that you are making it shifted right for the client, even to the detriment of your own revenue model, but you're doing it for the right reasons. And you said, but we still make great money because we sell more policies to more people. So you're having a greater impact on more business owners having the right policy. You're making money, so you're a win, and you're educating the space on how permanent insurance actually works.
Right. And I don't want to crap on term. Term, it fits in certain cases. So in that example, if someone came into me and they had $2 million of term insurance and they said, hey, I want to do one of these high cash value life insurance policies, 20, 50, 100 grand a year, doesn't matter. And we engineered it to have the lowest death benefit, and the death benefit was 300 or 400 grand. I would say you can't cancel your term insurance if we look at your overall needs and you need that to protect your family, your business, whatever. But eventually your 300 grand of death benefit is going to grow to millions of dollars. So eventually we can get rid of your term when it starts getting really crazy expensive as you age. So I don't want to come in and say you shouldn't buy death benefit. Death benefit is real important, especially with kids at home and university and businesses and partners. You need death benefit, but term insurance is, I have a client I met with one time and they said, we have a buy sell. We want to do term insurance. And I said, cool. How long has the business been in the family? 50 years. How long do you like to keep the business in the family? They said forever. I go, you don't have a temporary problem because term insurance is going to expire at age 75, going to keep going up in value or in price. You have a permanent problem. If you were, two buddies that were going to sell the 10 years, great. You can have term insurance to take care of the needs for the next 10 years. But in a lot of family businesses, the problem goes on forever. And that's kind of a side issue. But for permanent insurance, your death benefit is going to be lower. So it doesn't mean you don't need term. You just don't need as much of it. And eventually you won't need term. But the focus is on the cash value as basically a spot in your balance sheet to say, I'm saving, instead of saving my money in my bank account earning zero, or instead of putting it in a volatile asset like the stock market that could drop 40% when I'm ready to pull the trigger on an opportunity, I'm going to put it in an environment where I know consistently it's guaranteed to go up every year and grow, allows me to leverage it, comes with a death benefit. Corporately, well, I want to get into that later, but it'll change your life. And then the death benefit later on is going to be huge for you when you get older.
Again, now I understand why we resonate so well together, is because my viewpoint on working with a client at MBA is we need to look at the whole picture, figure out exactly what they're trying to accomplish for their life. What are they really trying to accomplish overall? And then our advice is tailor-made to ensure that they get to that goal. Instead of taking the one size fits all for insurance and saying, it's all permanent or it's all temporary, it's this or term, you're saying let's build the solution around the goal that you want. And I love the analogy of you keeping the term while you're growing up the permanent. And then once you're able to, dropping the term off as the premiums go up. And as you've alluded, that premiums keep getting higher and higher as you get older and older and older. Now, previously in the podcast, you referred to me as being 40, and that was very kind of you, but I'm 55 years old, and I've seen the premiums going up on some of the term insurance I have, and I'm starting to think, 75 is 20 years away. As you said 75, it just ends, right? Term ends at 75?
70, 75, or 80, depending upon the company.
Okay, so term eventually goes away, and hence why that's part of the statistical reasonings why some of it doesn't pay out, because eventually if I grow up to a point where it's too expensive, I drop it. Or if I get to be over the age, it drops. So naturally, that would lend to part of the 99%.
And you have to medically qualify. So if you can pass a medical today for term insurance, what's the likelihood you're going to die in the next 10 years? So we're not talking about the average population. We're talking about people that medically qualify for insurance. Are they going to die in the next 10 years? Possible. Could be hit by a bus. Could have, cancer. Could. But the likelihood of them dying in the period of time that the term is going to be good for is a lot less likely.
So we're adapting the life insurance to fit the person's lifestyle, what they want for the business. Can you just kind of summarize again or paint a picture of what it's like for the business owner? Because our business owner clients are the ones I really love focusing on. When they go and they get this cash or this permanent insurance, and as it's building up, can you just kind of go through all the benefits of having that in the corporation? Because you alluded to that. Like, let's talk about the corporately owned life permanent insurance and all the benefits kind of wrapped around there as simply as we possibly can without, too much shock and awe with the listeners because of the complexity of some of these issues.
Yeah. So let's look at a business owner, and I'm going to talk about a business owner that's going to have retained earnings. They didn't blow everything out into salaries. So let's say you earn $100 inside your business. In Canada, depending upon your province, you're going to pay roughly 12% tax on the first $500,000. So you're left with 88-cent dollars, we call them, right? Depends what province, could be 80, 86, 7, 9. So 88-cent dollars. So what can you do with that? Well, I can take those 88-cent dollars and I can give myself a dividend, or I could have taken the full dollar and give myself a salary. And if you're a higher income earner, you're going to be left with about 50 cents. So business owners look at their corporations as, well, I'm going to leave money inside my corp because I have 88 cents instead of 50 cents. So it's a good idea. But what are the problems when you go to invest those 88-cent dollars in your business? Okay. Well, you're going to pay tax on the growth. Could be upwards of 50% if you're going to be in some kind of fixed income. You're going to pay tax when you go to spend that money and get it outside the corp. You're going to pay tax when you die, that money inside the corporation. You're going to potentially have a passive income grind if you earn more than $50,000 inside your, say, holding company to affect your opco. And you're going to have that first dollar capital gains inclusion. So you've attracted 5 levels of taxation as a business owner by potentially leaving that 88-cent dollar in your business. We come in and we say, hey, why don't we put this vehicle in place, this cash value life insurance, where we're going to take those 88-cent dollars and we can put it right inside an insurance policy inside the corp. We will avoid the tax on the growth. We will avoid the tax because it's tax-free growth. We'll avoid the tax on the spend because the loans are tax-free. We'll avoid the tax when you die because insurance is received tax-free. We'll avoid the passive income because there's no tax slip. There's no reporting of the growth on this. And there's no capital gains inclusion to be had. So we've eliminated kind of 5 levels of taxation. Now, again, in a perfect world, we're going to do that in the holding company, not in the operating company, but those 88-cent dollars effectively are going to fund that policy. So as a business owner, you have a 76% advantage day one. Instead of taking 50 cents, personally, you have 88 cents. So that's 76% more day one. And you can grow that money, use it for your business if you need to. You can say, great, we're going to buy some trucks next year or heavy equipment, whatever. I don't want to go to the bank. I can go to the insurance company and say I want to borrow 90% against that. Cash value still continues to grow the exact same whether you took the loan or not. You pay that loan back. You do 10 loans in the next 10, 20 years. And then you hit retirement and you go, listen, cool, this policy was great. I was able to access money when I needed it, couple downturns. I was able to take advantage of some cool opportunities. I'm a lot wealthier now. What do I do with this now? Well, there's all kinds of things you could do with it, but one of them is you can actually get a personal loan on a corporate policy. So now, let's say you get $1 million in your cash value. You've used that money for the last 20 years. Now I retire, I can get a personal loan on that corporate policy and let's say spend $100,000 a year on that loan and never pay that loan back. So what happens? My loan starts going to 200, 300, 400 plus interest. My cash value, though, is still $1 million, growing to $1,050,000, $1,100,000, $1,200,000, $1,300,000. So as my cash value grows, my loan will grow, and then you're going to die. But the death benefit now is going to be like, say, $3 million in my example. So the $3 million death benefit goes to the company. How much does the company pay tax on death benefit? 0. The money flows out of the capital dividend account. Depending when you die, could all flow out completely tax-free. $3 million goes to the family now, and they pay off that $1.2 million or whatever your loan was for that tax-free income. So you've had a tax-free retirement. You've grown your money tax-free. The only tax you really paid is that 12%. Now, that personal loan is one retirement strategy. I talk about 5 in the book, but like that's one of the ideas that you can do. So as a business owner, to me, it is the ultimate savings plan. It is the ultimate future retirement plan, and it's the ultimate growth plan because I know whenever I need money for an opportunity or emergency, I can access money, no questions asked.
Savings, growth, and retirement.
And death benefit. Yeah. Protect your family as well.
Yeah.
But the death benefit in retirement is actually sexy. Like, but let's talk about your house right there. So you get a house in Victoria. Let's say, you're 70, 80 years old, and that house probably worth $10 million or more by then, or 20 million, whatever. Let's say 10 million. Okay. Well, you're not about to go out at age 80 and go, hey, I think I'm going to get a mortgage on my house. And, or a lot of people wouldn't feel comfortable with that. But if you...
And the bank wouldn't lend on it either. The bank wouldn't lend money because I wouldn't have any cash flow. If I don't have the cash flow to service a mortgage, they still won't lend on that million. They won't lend on the real estate at all.
Sure. Okay. So let's say you're 65 and it's worth whatever, $5 million, and you go get a line of credit, even 50%. Okay. Well, you're not cool about that. You don't want to die with this big line of credit. But if you knew you had a bucket of tax-free money that was going to pay at your death to replenish that wealth bucket, your house, then I look at this and go, well, maybe I'll take $100,000 a year line of credit on my house, or maybe my income properties. I will refinance the crap out of my income properties in retirement. How much tax do I pay on refinancing? 0. I take that refinance money. Great, I'm going to die with slightly higher mortgages, but my death benefit now is at 20, 30, 40, 50, 60 years to just skyrocket. So there's going to be millions of dollars that gets paid to my family to take care of those properties that I refinance, to take care of those mortgages. So there's all kinds of things you can do in retirement to effectively spend your own death benefit. You're not technically spending your death benefit, but it gives you to spend your money differently.
So we've been talking about a lot of kind of detailed stuff, and it can be very overwhelming for someone who's not following along. Like, I'm following you just fine. I'm kind of zip, 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 zip. I follow D. Here you go. Yeah. Okay. Let's do this. But for the listener out there, the thing that I want to kind of share with you is that I think there is a great opportunity to use permanent insurance with your company, with your business, to really compound, I'm using the word, buddy, compound your growth and your retirement and your lifestyle. I love the fact of being able to access that during difficult times, because especially when the banks all of a sudden start tightening up, everybody's tightening up, it's harder to find money, especially with the interest rates going through the roof where they went. Now, at least interest rates are slowly creeping down now as the Liberals try and position themselves properly for their next election that's going to come up. But at least the interest rates are coming down. Well, when the interest rates skyrocketed, everybody was having a heck of a time getting money. Imagine if you'd had a life insurance policy in your corporation that had $1 million sitting in there and you could just go access that when you need it. I really love this as a strategy. But the thing that I wanted to highlight the most is you need to have someone who understands this, who can look at your situation and work with your accountant. So you'd have someone like Darren and someone like Peter at MBA to work, and they will work together to find the solution that works for you, that's the right fit, so that you can control and compound your wealth. So Darren, as we go to end the podcast here, where can people go to find you, and what kind of resources do you have so that they can investigate this? And for those of you out there who are thinking, oh, I don't want life insurance, I don't like life insurance, I just want to leave you with this one quote, and then Darren's going to tell you where you can find his information and resources, is nothing will keep a person in everlasting ignorance. It's contempt prior to investigation. So if you don't go and look and find out from someone who understands this stuff and someone you know, like, and trust, you will never know. So go explore this. I highly implore that. But Darren, could you tell people where they could find you and more resources to help them decide if what's right for them?
Sure. So we actually have a special landing page just for the MBA podcast listeners. It should be in the show notes. We said it. If we haven't sent it to you, we'll send it to you. But I think it's controlandcompound.com/MBA podcast, something like that. But we'll put it in the show notes. Or go to Control and Compound. And what we have there is we have a couple free webinars. You can watch webinars to learn about it. You'll be able to access our podcasts, or you can go on Apple and Control and Compound, listen to our podcasts. We have links to my 2 books, Be the Bank and Infinite Banking for Real Estate Investors. They're available on Amazon. And again, education guy, the Kindles are 99 cents. We're not making money on this. We want to educate people. Like, it's $10 for the paperbacks. And then the ultimate thing is you need to book a coaching call. We work in every province in Canada, unless you're in the French one. And we only do education calls. So you meet with a wealth coach. They do a generic, this is how it works. We answer your questions. If at the end of that, you think it's cool, great. We'll do a second presentation, get into your particular circumstances. But, a mentor told me once you catch this, you can't uncatch it. But you don't just wake up one day and say, I think I'd like to put a bunch of money into life insurance. You need to invest in you. And part of that investing in you is learning about new concepts. And this is a concept that's been around 150 years, but it's new to a lot of people. So you need to invest a little bit in yourself to educate yourself on this. And we've got all kinds of resources at Control and Compound that can help you do that. Once you educate yourself, if you think it's for you, then reach out and book a complimentary coaching session with one of our wealth coaches.
There you go. Controlandcompound.ca, just so everybody knows. Controlandcompound.com. I'm going to be doing that. We're going to go check out, because we're going to start looking at the policies we have and see what kind of options we have, because I want to go through the process myself. So there you go. I'm going to go explore, so I'm not in everlasting ignorance myself. Darren, thank you for being on the podcast, my brother. I really appreciate it.
Anytime, Eric. Thanks so much.
See you next time, everyone. If you're a business owner or CPA who believes the accounting profession has let you down, then please reach out to us at www.mbacpa.ca so we can have a chat to see if we're a fit to work together. We're always looking forward to talking to you. See you next time.